Homeowners Insurance, Endorsements, and Other Residential Forms, Business 506, Cal Lutheran University. By the end of this lesson, you should be able to describe some of the most common endorsements to homeowners policies, recognize other types of residence insurance, describe the needs analysis process as it relates to homeowners insurance. An endorsement. An endorsement is a contract modification that either adds or deletes provisions to the standard homeowners policy. Homeowners policy can be endorsed up to meet the customized needs of the insured. Some common endorsements follow. Home daycare coverage. This is going to provide coverage to someone who has a business in the home doing daycare. The typical requirement is that they are licensed by the state, and then it provides basically business liability for a daycare operation in the household that would otherwise not be covered on the homeowner's policy because that's a business aspect. Coverage C, that is for personal property. So you can increase special limits. The standard homeowner's policy has $1,000 coverage for jewelry, for example. So any sizable diamond ring that could be in the household, you can endorse up to $1,500 per item, $25 aggregate, $2,500 per item, $5,000 aggregate. And if you're dealing with expensive rings beyond that, there's a separate policy called the personal articles policy that's going to cover that exposure. But again, that's an example there, special limits. Another example of special limits coverage would be guns. Policies might have a base of $2,500. It can be endorsed to $5,000 or $10,000. Computers and equipment, again, that's a special limit. $5,000, $10,000, very common amounts of coverage available. Silverware, goldware, there's art, antiques. So those are very common as far as the coverage C, increased special limits. You can see there's also a list here. Money, banknotes, bullion, gold coins, metals, scrip, stored value cards, smart cards, securities accounts, deeds, so important papers, evidence of debt, letters of credit, jewelry, watches, firearms, already mentioned that, and electronic apparatus for use in the motor vehicle, your GPS that you suction cup onto the windshield. Earthquake. In some states, actually in most states, the peril of earthquake can be covered by endorsement on the standard homeowners policy. Now, California, because we have all the big seismic events, it is excluded and cannot be endorsed on the homeowners policy. You have to purchase a separate standalone earthquake policy, most commonly through the California Earthquake Authority, which is a state entity. And other features about the earthquake, the deductible typically is a lot higher than the standard homeowners policy. On the endorsement, you'll see 5% of the coverage A or coverage C, whichever is greater, whereas they might have a $1,000 or $500 deductible on the coverage A on a regular homeowners. And the deductible percentage can be increased for a premium credit. And coverage for mason veneers is also an option for extra premium. Code upgrade is an option. There's a few different things on there that you can endorse up to make sure that if the house is damaged by an earthquake, that's going to be covered. And I already mentioned California here. And there are some insurers that still make earthquake coverage available in California as part of their homeowners policies. They are very few. There's also a separate standalone earthquake policy that's privately sold. Company's name is GeoVera. And the following statement is not a negative statement about GeoVera. They're a non-admitted carrier, and so the ability for the Department of Insurance to examine their books and records is not available. We have not had a seismic event, a sizable one, where they have had to pay out claims since 1994. The last big one was Northridge quake. So the California Earthquake Authority, in contrast, the reserves are over $6 billion. They are not part of the general fund of the state. They are specifically earmarked to go to the insureds after the next major seismic event. So, again, not a negative statement against the private company, but it's difficult to assess how financially solid the company is if they won't let people examine their books. Regulators examine their books, excuse me. In other endorsements, Inflation Guard. It's automatically provided on the HO3 and HO5 policy contracts, and the increase is aligned with the company's replacement cost software, or they will tag it to a specific index like the Consumer Price Index. It provides automatic coverage increases on an annual basis, and it can be also pro rata basis during the policy period if you have a coverage review with a client, for example, and it's midterm in the policy. You can adjust up midterm also, so it's a good thing to have on the policy. Personal property replacement cost settlement. Again, this is an endorsement. With it, you get replacement cost on damaged contents when they're damaged because of a covered loss. Without it, you would receive depreciated value, typically insurance companies using IRS guidelines for age and depreciation. Scheduled personal property. Whether it's on the homeowner's policy or whether it's a separate personal articles policy, also known as inland marine, that it broadens coverage on specific categories of valuable property. So example, jewelry. Breakage is not covered on the traditional homeowner's policy, but when you endorse it up, it can be covered. Each item is usually listed separately and insured for a specified value. Most carriers will require a current appraisal on a high-value jewelry item. So you can't use an appraisal from 2003 when it's 2013. You'll need to go out, the client will need to go out and get the appraisal. Coverage is all risks with very few exceptions and applies worldwide. And once property is insured under the endorsement, there's no coverage for it under Coverage C. So it separates out that scheduled property. And also, the Section 1 deductible does not apply to scheduled items. You can choose different deductibles, or you could choose the same one, but by default, it won't just be the same. The insurance producer, agent or broker, will be working with the client to explain what the options are and the associated cost. And losses can be settled on an ACV basis, actual cash value. However, fine art is written on an agreed value basis. Business pursuits. That's another endorsement. Provides coverage for Section 2 liability that arises out of or in connection with a business engaged in by an insured, most commonly used by persons in sales, clerical, teaching, those sort of things. Other residential forms. Their homeowner's policy doesn't cover every type of residential exposure. Therefore, additional forms are needed for other dwelling units, mobile homes, and farms and ranches. So dwelling policies, rental dwellings. Dwelling policies are used primarily for a residence that's ineligible for homeowners coverage for one or more of the following reasons. One is it's rented out, so a rental dwelling. The dwelling doesn't meet the insurer's eligibility requirements. It could be age, condition, highly customized house. It can vary by carrier. And like the homeowners forms, the ISO, Insurance Service Office, has several dwelling forms. There's the dwelling property form, a basic form, property form 1. Property form 2 is a broad form, and property 3 is a special form. So manufactured home policy, mobile and modular homes. The insurance is very similar to regular homeowners as long as the mobile home is owner occupied and meets certain underwriting rules. And under the ISO mobile home program, endorsement is added for either the HO2 or HO3 policy to amend certain definitions and policy provisions. Farms and ranches. Farm and ranch coverage tends to be written by insurers who use their own forms offering specialized coverage. Many of the policies look like homeowners policies but tend to be broader and provide additional unique coverages for farm and ranch operations. Scheduled equipment, tractors, backhoes, plows. Unscheduled equipment. This would be the lower dollar items. Pollution risk. So you're spraying a field or an orchard and the pesticide or herbicide drifts over and does damage to another area. That's another example of a specialized coverage on a farm ranch policy. Flood coverage. Flood is excluded pretty much from every insurance company. So the national government takes care of it through the National Flood Insurance Program through FEMA, so the NFIP. If the property is in a flood zone, then you'll need to get a second insurance policy to cover the peril of flood. Title insurance. You typically deal with this one time when you purchase the property or otherwise transfer title. And the insurance is designed to protect the purchaser of real estate against defects or clouds in title that can result in the loss of ownership, or that can be corrected only after certain costs are incurred. Floater policies. I mentioned the personal articles floater earlier. It's used to provide all risk coverage for certain scheduled items of personal property, jewelry being the most common. Sports equipment, a $2,000 set of high-end golf clubs. That's a common thing to insure. It can be for computers. So your laptop is away with you at college. That you can get coverage for that because those tend to suffer from drops frequently. They tend to be stolen frequently. That's something you can schedule. Personal property floaters designed to provide all risk coverage for unscheduled personal property on a worldwide basis. So it's a dollar limit of coverage, basically. Personal effects floater is a floater designed to provide all risk worldwide coverage on properties such as baggage, clothes, camera, etc. So kind of travel insurance, but not for the airfare and lodging, but for what you're taking on the trip. Property insurance needs analysis. So some preliminary issues about insuring the residence. Homeowners should allow you to rebuild and refurnish your home after a major loss. So reviewing the coverage amounts to make sure it's adequate is something that's very important to the client. It also provides coverage for your defense and indemnifying third parties if a liability claim is made against you. That's personal liability. So some other issues. Coverage requirement. On the physical the physical property of the home itself, typically a minimum is 80% of replacement cost is a threshold. The insurers will make us start at current replacement cost, so 100% insurance to value or 100% replacement cost. Over time, that can diverge out, up or down. And if it diverges down below 80%, well then you lose a lot of the settlement provisions in the homeowner's policy. And that's not a good thing. So as an insurance producer, we need to review clients' insurance every couple of years for accuracy. So policy coverage for contents and liability. Most homeowners coverage do this in a range of 50 to 75% of the coverage A amount. And liability, the bottom line liability on most policies is $100,000. It can be endorsed up higher, $250,000, $500,000, $1 million. But if we're looking at higher limits like that and we have assets to protect, it may be more cost efficient to get a liability umbrella. So the process of analyzing the needs: one, know your client as far as their goals and priorities, taking inventory of physical assets, identify risk exposures, and be aware of other financial assets and emergency funds. Second, review the current plan. Look at their homeowner's policy and the associated endorsements to it. Make sure they're all relevant to the client's situation. And that goes to the third point, and that is assessing alternatives and offering recommendations to improve the policy and tailor it to the client's budget and the client's needs. Talked about reviewing the current homeowner's policy to address current gaps and weaknesses. So it could be the replacement cost if it hasn't been reviewed in many years. And that goes to the second bullet point, which is the impact of inflation on rebuilding costs. The value of personal property. Special personal property that is not adequately insured under the standard policy. Antiques, fine art, high-value jewelry. Amounts of liability insurance, and the catastrophic risk exposures, hurricane or windstorm, floods, and earthquake. Reviewing condo insurance. The important issues to consider of a condo unit are the condominium bylaws. For example, property that needs to be covered by the condo owner versus what's covered by the association in the master association policy. Next is an assessment charge. And if you have this endorsement on your HO6 condo unit owner's policy, it'll provide coverage if an assessment is made against you as a unit owner for a loss where all the owners are assessed. Value of condo features. So these are the improvements that you do as the owner of the condo unit. Value of the possessions. Your furniture, clothing, your personal property, like coverage C on the homeowners. Special personal property, again, antiques, fine art, those sort of things. If the client has an extensive art collection, we need to make sure it's covered properly under the condo coverage, or do a personal articles policy for the fine arts. and also review the amount of liability insurance. So some important issues to consider as a renter. One is the value of your possessions. Next is special property that's not adequately insured under a standard renter's policy, and also the amount of liability insurance. Just because someone's a renter doesn't mean they don't have assets. So again, liability can be endorsed up just like a homeowner's or HO6 condo unit owner's policy. So important issues to consider as a landlord. So the dwelling policy. You need a separate policy of renting to others, the rental dwelling policy. You need to insure the property and any personal belongings left in the rental. Typically, you will see very limited personal property compared to the homeowner's policy. The reason being is, if you're renting out to others, it's their stuff that's in the house, not your stuff. You might have an owner's closet or an owner's shed to have equipment for the maintenance and upkeep of the property. That's where the personal belongings go into play. And also to maintain business liability insurance. Typically, most companies, the minimum amount of liability coverage in a rental dwelling is $300,000, whereas in the homeowner it was only $100,000. So in summary, we reviewed endorsements of the homeowner's policy, other types of residential insurance, and homeowners' needs analysis. Thank you as always for your time.